Hi Crypto World, my name is Yuvi Ivanova, and today in the Thought Leader series we have Kenny Rowe. Kenny is the COO of OurChain, an advisor to CoinFund, and an early team member of MakerDAO, one of the oldest organizations in the Ethereum ecosystem. In this episode, we talk about stablecoins, the three different types available now, their benefits and downsides, and potential uses. We also talk about third-generation blockchain technologies and how they're different from previous generations. This is the first half of our conversation with Kenny. For all the links and show notes from this episode, go to cryptoradio.io/Kenny1. You can find the second half of this episode at cryptoradio.io/Kenny2 once it goes live. This episode is brought to you by MakerDAO, a decentralized autonomous organization that creates and backs the DAI stablecoin on the Ethereum blockchain. DAI is available for purchase on several decentralized exchanges such as Oasis DEX and Paradex. For more information about how DAI works, go to cryptoradio.io/maker.
Welcome to Crypto Radio. We interview the top thinkers and entrepreneurs in the blockchain and cryptocurrency industry. We also cover topics like trading, investing, and ICOs. We're your hosts, Mike Gilliland, Michael Pohl, Chris Sparks, and Yuvi Ivanova. We're entrepreneurs, crypto investors, and co-founders of a new blockchain investment platform called CoSyndicate.io. We created CoSyndicate and Crypto Radio to make crypto investing a better experience for you. If you're new to the show and you'd like a list of our top episodes and resources, go to cryptoradio.io/start. If you like our podcast, you can subscribe, share, and follow us on social media and leave us a rating and review on iTunes and elsewhere. It helps others find the show, and we really appreciate it. You can find all those links at cryptoradio.io/start. So Kenny, welcome to the show. It's good to have you finally because we've been friends for a while. We've been chatting quite a bit over the last couple of years. How we met was pretty interesting, actually. I think on Twitter you posted, anyone who donates to the Future Thinkers podcast, I'll match them.
Yeah.
I think that was how you were trying to get our attention for something. And we're like, who the fuck is this guy? And then we just got chatting after a while and we had a lot of great conversations. So welcome. It's nice to have you.
Thanks, guys. It's really a pleasure to be here.
So why don't you give the audience an introduction of what you do and what you're interested in and that sort of stuff, and we can just start from there.
So I've been working in the blockchain space for a couple of years now. I started and still continue to participate in the MakerDAO, which is a stablecoin project. So I've worked on that project for a few years. I had worked on it full-time from probably mid last year or early last year for maybe about 6 to 9 months. And now I've transitioned to another project mostly, but I still am involved with Maker on some governance issues and a few other things here and there. So that's a stablecoin project. And I've also done some consulting for CoinFund, which is a really great outfit out of New York. And then I've also, right now, I'm working on a Generation 3 blockchain platform called OurChain. And for that particular project, the governance model is fairly interesting because it's a cooperative. So I'm actually a part of a cooperative. That's my job. I actually work for a legal incorporated company, which prior to that, there was this idea of a DAO and you could kind of come and go as you please. But I think it's a lot of people are trying to figure out what legal structures are for the blockchain as well. So that's kind of a bit about my background. Mostly I do a lot of stuff in any given project to sort of fitting a need wherever there is one, but mainly focusing on operations and some marketing and coordination between different parties and smart contracts and all kinds of stuff. So that's a little bit about me and what I'm up to these days.
Cool. What are you guys up to with Maker? I mean, for a long time, the Tether was kind of the only stablecoin on the market. And now you guys have come in and you've actually been doing this for quite a while. As far as I know, you guys were around even before Ethereum?
Well, not quite before Ethereum, but very close to the original launch in 2014. There's an original post by the founder of Maker, Rune Christensen, called the $E. And that was sort of the beginning of the sort of idea. But it had its precursors in BitShares with the BitUSD. So there was some precedence for this idea. But yeah, the project has been around for a very long time. And it's one of the oldest projects in Ethereum because it was one of the things that you could do with a smart contract. And then why would you want a stablecoin and what kinds of stablecoins in there? I think is also an interesting question. So you mentioned Tether. Tether is a kind of stablecoin. Maker, the stablecoin there is called DAI. And then there's also another type of stablecoin that I think will be interesting to talk about. So the different flavors that you have of stablecoins So something like Tether is proxy for a fiat currency. In this case, Tether is tethered to the US dollar. This is how it gets its name. And the basic idea here is that it's for every one Tether that exists, there should also be $1 that's held in the bank account by some central party. It's a fairly straightforward way of producing a stablecoin. And the reason it's stable is because fiat currencies tend to be fairly stable. They're centrally managed. They're already scaled. They're used all over the world. In fact, that's the primary means of exchange and commerce right now are fiat currencies. So that's why they're stable. The trick with things like Tether, or the concerns that a lot of people have, is that it's somewhat difficult to make sure that there really is $1 in the bank account. So you'll see things like the amount of Tether's supply increasing quite dramatically and quickly, and sometimes $2 to $3 or $400 million in a week or two, which is not necessarily an indication of anything untoward going on. It's just unusual that much currency could be flowing through these counterparties that quickly. Of course, they could be of accumulating this over time and then just released it all at once or to meet demand. But it is curious that Tether tends to meet the demand that it has fairly easily. They have ways of trying to be as transparent as possible, but that's the risk that you have with a stablecoin like that. You're trusting in that party to be honest, to not embezzle money, to actually have the reserves that they say they have. Oftentimes in those schemes, you would also want to be able to convert into both currencies. So if I held Tether, it would also be really great if I could go to Tether and then get USD, but that's actually not super easy and straightforward, mostly because they need the Tether to stay in the market to kind of stay in the economy. And traditionally, what you use right now for stablecoins is just trading pairs. So a lot of, let's say, either Bitcoin or Ether will be traded for these US dollar equivalents. And then people can hold them and they tend to stay in value. Then you can move them quickly into something else instead of trying to actually go between systems like that. Meaning monetary systems like a blockchain system and the legacy financial systems, which tends to have a lot of friction and a lot of fees associated with it. So you just lose a lot of value if you're trying to do that. So stablecoins are very useful for traders because they help them manage their risk. Stablecoins are also very good for just normal economies because you don't want to be using a token to exchange for goods and services. That's going to change a lot in value over time, because if I'm going to pay for a service now and I'm going to pay for it over time, that change in price over time of any given currency, I want to know what my future obligations are going to be. So that's kind of why we have stablecoins. So where does that go from there? So you have this kind of centralization problem or concern, but Tether is also what we would call a collateralized token. There should be $1 for every one Tether. So there's another way you could potentially do this stablecoin thing with collateral. And that's what Maker's approach for doing this is. So it's a fairly straightforward model where we take collateral on the blockchain, like Ether, for example, which is just another cryptocurrency. You lock it up in a smart contract. And then by doing that, it creates new currency. And this currency we call DAI. So the reason why you have this collateral is so that DAI is always backed by some other form of value. Now, when you do this with some volatile form asset that goes up and down in price a lot, then you have the additional requirement that it needs to be over collateralized. So whereas Tether, you can get away with 1-for-1 because that's the idea, right? It's supposed to represent $1. If you want to represent the value of $1 in Ether, you really have to have about 150% at least of Ether in order to create so you need $1.50 in order to create $1 of DAI. But what we're actually seeing in the system since it's been live is that it's actually a bit more common to have somewhere around $2 to $3 backed in collateral. We have a dashboard too. If you go to DAI.makerdao.com, you need the MetaMask plugin to read the information coming off the blockchain. It'll have some statistics about how the entire system is doing and what the collateralization ratios are and all that kind of stuff. It's just an interesting way to see the metrics. So that's how you would do it. The next version of DAI will have multiple kinds of collateral, because right now there's just one. So all of your risk is in that one type of collateral. Then we'll have multiple cryptocurrencies, but even still, with multiple cryptocurrencies, you do hedge your risk a little bit. But really, it's not that much. If anybody's familiar with cryptocurrencies, they all tend to kind of go up together and down together. So there really does need to be hard assets or real world assets that are represented on a blockchain. And we're starting to see some things like that. For example, there are 2 states in the United States that are fairly progressive in this field, Arizona and Wyoming. So Arizona already has legal precedent for tokenizing real estate, which is a fantastic form of collateral. Another form of collateral, like from Digix, which has been a partner with Maker for years, is gold, right? So then you have hard assets. When we have hard assets that don't have as much volatility like that, then we can reduce the amount of collateral needed in which to produce these stable coins. The stable coin is actually, there's a bit of a misnomer here that it's supposed to always be $1. It's actually not supposed to be $1. It's supposed to have low volatility, which means we do not want the price to change high or low over a short amount of time. We're actually not too concerned whether the price tends to creep up over time or even tends to creep down over time. Those are just sort of market forces that the system will just sort of monitor. What it's really looking for when it changes incentives, and what I mean by that is how much does it cost in order to create new currency, new DAI, or to redeem it for collateral. So you can change those parameters, and then that would tend to increase or decrease the money supply, and then that would either raise or lower the price based on some external reference. Originally, Maker was looking at some basket of international currencies, sort of like the SDR, which is the standard drawing right from the International Monetary Fund, which is, I think, some of the 5 largest currencies, the USD, the Euro. They just added the Chinese yuan, those types of currencies. You could kind of bundle them all together. The real idea is that you want, well, low volatility, but you kind of want something that is sort of understandable in a day-to-day context. So the example I like to use is if you have a stable coin and it costs $1 to buy a dozen eggs, or 1 stable coin to buy a dozen eggs, it should generally cost 1 stable coin in a year or 2 years. Not necessarily quite that strictly, but it should be fairly understandable over time. And that's generally what we do see from our fiat currencies now, unless you live in countries like Venezuela or Zimbabwe or some of those places. So that's kind of the overview right now from where Maker is. So we had a hard cap of 15 million while we're still sort of in beta, maybe 30 million DAI. And I think we're at 60% of that right now issued. And that's gone through a couple downturns. And so far, the system has been robust enough to maintain those sort of downturns in price. And what happens in those systems, or in these locked positions, we call them collateralized debt positions, CDPs for short. If the value of Ether, which is the collateral, goes below a certain value, then the position is auto-closed by the system, or it becomes closable by anyone who would call a certain function. And then the collateral is liquidated into the system, and then that creates with an incentive to buy it at a discount so that it clears the debt. So all of the debt from the system when it was prices were going down was all cleared out and everything remained collateralized. And in fact, as far as I know, the BitUSD, even prior to Maker, this is in the BitShares days, that has remained fairly stable as well. They haven't had any death spirals, so to speak, where it kind of the price swirls down so fast that the system can't handle it. But that is a concern. And so we actually do have a backstop in case some collateral type just goes to zero. So in that particular case, what happens is there's another token called MKR. And MKR, it has value because when you close a position just normally, you need to pay a fee to do that. And that fee is in terms of MKR. And then the MKR that is used is then destroyed. So the supply of MKR is always shrinking. And it's a very limited supply to begin with. There was only ever 1 million coins minted. So it's one of the more rare currencies out there. So it tends to have a very high price, but that's sort of on purpose. It's sort of like the Berkshire Hathaway of cryptocurrencies. So that currency is the ultimate backstop. And how that happens is if a collateral type goes to zero, then MKR is actually inflated. It's created out of fiat, so to speak. And then that is used to cover the bad debt. That's how we address that kind of radical, quick, toxic asset type problem. So the benefit here is if you hold MKR, traditionally when supply goes down, price goes up. And then the other way around is if something happens where a collateral type fails, then it gets inflated and then the price will go down. Now, the trick here is that MKR holders are the ones responsible for choosing the collateral. What is good collateral? And the other parameters of the system, which we call risk parameters. So if you are an MKR holder, you're responsible for having some economic background or delegating your vote to someone that does to make good decisions so that your MKR isn't inflated away. And if it does happen and it's inflated away, that's an opportunity for someone who does know what they're doing to grab up the cheap MKR and then exert better governance. So that's the kind of the system in a nutshell. But just from the amount of time I've been talking about it, you can see it has a couple downsides, right? One is complexity. It's much more complex than something like Tether. But the trade-off here is decentralization. So there isn't any one person or one entity involved with this entire system at all. In fact, the Maker DAO that we kind of refer to really refers to a system of smart contracts that we've just been discussing. It doesn't actually refer to the people and the organizations that are currently building it, at least in my opinion, because those are structures. Those are legal incorporated entities. They have, presidents, they have co-founders, all that stuff, right? It's not really a decentralized autonomous organization. But the collection of these smart contracts, it kind of is. And hopefully, so to speak, the incentives are aligned correctly and the safeguards are there so that it's robust enough to survive the ups and downs of asset classes and capital markets and to produce something that's really valuable for the rest of us. And so far, DAI is being adopted by several exchanges, and the Oasis DEX is the most prominent decentralized exchange that is using DAI as trading pairs. And there's also another really great one called Oasis.direct, which is sort of like a decentralized shapeshift. They've only got the 3 tokens at the moment, but it's starting to catch on. It's really cool. And some interesting things you can do with it. Just another example is if you have a ton of Ether. So if you were lucky enough to have been in this space for a long time, but you're really bullish on Ether, even still like long term, right? So you don't really want to sell your asset, your Ether, to do something in the real world, but you would really like to be able to do something with your newfound wealth. Well, something you could do, and we have actually heard of people doing this, you can take your Ether, lock it up, extract that DAI, and then use that DAI to do real world things like refinance your house. And what I mean by that is you take the DAI, you get USD for it, and then you pay off your house completely. You don't have any interest. You own your house, the property, free and clear. You still have debt, but the debt is now on a blockchain and there's no interest for this debt, but there are fees involved. But right now, in the early part of the system where we're still kind of testing things out, all the fees are exceptionally low. I mean, we're talking like 5 basis points, right? So it's a few $1,000s. You could, for a few $1,000, essentially, you could refinance, your entire house and stop paying interest, which is really interesting to a lot of people, right? Now, of course, there's risk involved with that too, because if Ether drops in price, you could potentially get covered, like forced covered, meaning your position could be auto closed. And if that's the case, then the fee for that is something more like 13%, which is, that's a lot more than your standard interest rates in most places. But, do your homework, be educated, but it's still really interesting. And if you're really high risk, like if you really are bullish on Ether, you can do the same thing where you lock up a big chunk of Ether and then use the DAI to buy even more Ether. So this is what we would call a leveraged position. So now when Ether goes up, your value is going up much quicker. And then the same is also true. It's going down much faster as well. And so that particular use case for me is particularly scary because of leverage like that. Leverage trading can be very unpredictable. And I wouldn't really recommend anybody do that, doesn't really know what they're doing and doesn't never do anything like that with funds you can't afford to lose, for sure. But using debt or an instrument like this to produce additional value in the real world, financing a new business, paying off your house, buying a car, all of those things, provided that you can still make payments on them, but you can make payments at your own discretion. That seems pretty interesting to me, as well as just using it as a trading pair. You don't have to open a CDP. You can just buy DAI with your Ether or hopefully soon a Bitcoin or something else like that, and then just use that to trade with other people on the blockchain, which would be fantastic. So that's Maker. And then I'll briefly touch on one other type that hasn't launched yet, which is still fairly interesting. There's another kind of stablecoin that doesn't use collateral. Okay, so there's nothing backing it. And the general idea here, this was an idea called seigniorage shares. And here you have a monetary base and then a smart contract that is monitoring the price of this token. And then if it increases in value, then it decreases the monetary supply and vice versa, right? And this is essentially what a central bank does, right? They monitor the core consumer price index and a bunch of other indices, and then they try to manage the money supply to cover that. Now, you can't just do that because the Fed has a way, Federal Reserve of the United States has ways of which they can actually remove money from a system or increase money. They create it and then give it to banks, and then banks distribute it, or at least they're supposed to. That's the way they increase it. And then if they want to remove money, they buy bonds and then they sort of destroy them, which is U.S. Treasury debt. So that's the basic way that the Federal Reserve does that. So any implementation of this idea on a blockchain would have to have some similar mechanism for taking money in and pushing money back out into the system. So more likely than not, it would be bonds or rights to the next issuance of seigniorage, which would be this increase in value or increase in currency. With this one, it still has the complexity issues that Maker has. So they're both sort of similar trade-offs in that sense. It's more economically efficient because there's not this over-collateralization requirement. But then you also have the other problem of it's sort of a Ponzi scheme because it only works when there's sort of keeps growing. In order to sell a bond for the rights for the next issuance, you need to have enough next issuance. So it could be argued that governments in general are Ponzi schemes, and I think that's a bit of a harsh criticism. I think the description of what a Ponzi scheme is it's a bit of a spectrum, meaning if you design an economic game that is intentionally trying to extract money from people in order to give it to yourself and early investors, i.e. what the man Ponzi did, that tends to be very destructive. And that's what we call a Ponzi scheme. But something like a government, even though it does have the same general pattern, isn't destructive. Another example would be like Social Security in the United States. You always need younger people paying in order for the older people to get their benefits. That's not bad, but it follows the same pattern. But you have to be careful because these patterns aren't sustainable. They always tend to crash at some point. They just become unsustainable. For example, I have no plans of drawing ever any Social Security myself just because I don't think the program will be solvent. I just don't. And I think a lot of people in my generation don't. But my parents, they're great. And I'm really happy that they're going to get Social Security because it's a great benefit. So that's the criticism that you would see from an uncollateralized automated system that would kind of manage money supplies like a central bank. It'd probably be really great and potentially for a long time until it wasn't. So that was a long diatribe. So that's the landscape of stablecoins currently, as I see it anyway.
I'm interested in how all those different types of stablecoins react to black swan events.
Yeah. So in Tether, your black swan would be isolated to any, let's use a more controversial term for USD, petrodollar. Okay. And where I'm going with that is, let's say there have been some experiments in Venezuela, one might say desperate experiments to create sort of commodity-based tokens or cryptocurrencies backed by something like oil, right? So when Venezuela did it, it wasn't really seen as any sort of legitimate or even trustworthy program. But let's say if China and Russia and a few other Southeast Asian countries all did the same thing, where you actually had faith that you could redeem this petro token for petrol at a port, let's say in China, because there are massive infrastructure connections between Russia and China, whereas you might not trust Russia, but you do trust Russia to continue to produce. That's just within their best interest. And there's enough in the pipeline that you could probably get your petro token out from China or some other port. So in that sense, if you had trust in being able to redeem the token and you could actually see that it's working, that has massive, massive implications for the current state of affairs for the US petrodollar. Because all petro right now is traded in US dollars, or the vast majority of that. If that ever changes or even looks like it might change, I don't know if you could quite consider that a black swan event, or maybe you tie that with a very contentious election in the United States all happening at the same time, and potentially other kind of civil unrest, like maybe a secession movement or one or more states. You could see how some of these things could kind of pile onto each other, because a secession movement would then obviously require that seceding state to create its own currency. So let's say this is really black swan, right? But if California decides that they've had enough and they want to split off, and they would be, roughly speaking, the 9th largest economy in the world unto themselves, or Texas for that matter, because Texas is the only state in the union that has the legal right to secede. That was part of the requirements when they joined the union. So they could actually do that legally. And Texas is a massive state. They have a huge economy. And let's say you have a very contentious election. We actually kind of expect the next one to be contentious. So that's not out of the realm of possibility. And then you have some crazy experiment by the Chinese and the Russians to create some new currency, blockchain or not, that's represented by oil. If all of that happened at once, that could seriously destabilize the US dollar. So would that change what Tether is doing? So it wouldn't change Tether so much because Tether would still be tethered to the dollar, right? It would just be an issue of weird prices. But Tether itself would always remain $1, but it would be completely tied to the fate of whatever is happening with the USD or euros or, whatever you tether them to. That's kind of the collateralized fiat way of doing it. And in Maker, the black swan events, it was more likely than not a complete collapse of crypto in general, right? Which is not out of the realm of possibility. In fact, some people that I talk to think that that's much more likely than some people might think, just because we haven't really seen, besides some financial innovation and a few other interesting proof of concepts, we haven't seen like world-changing type applications quite yet. I would say that's potentially true, but I don't think a complete collapse of crypto is likely. But a very large collapse is. We see 50, 40% price declines usually every 3 to 4 months. So far, that hasn't seemed to dampen any kind of excitement or forward momentum. So it's hard to imagine what level of price decrease really would do that. But if, let's say, the World Trade Organization or something like that, or some transnational organization convinced most jurisdictions to ban or make illegal all of this stuff, which I think would be very unlikely, that potentially could do the kind of damage where you would see all crypto going to very low values. And in that case, Maker, if it didn't have real world assets, would probably not survive that, depending on how quickly it happened. Because if it happened slowly enough, the system would sort of gracefully unwind down to very low levels of usefulness. But if there were real world assets like real estate, which seems to be fairly straightforward, in gold and potentially a few other classes, it could potentially weather something like that. Another thing that would potentially kill something like Maker is a fundamental flaw in the blockchain in which it was deployed on. So let's say that the cryptography behind the Ethereum network was suddenly cracked. That would just totally invalidate everything, right? There would be double spends everywhere and you really couldn't recover from that. But Maker is sort of aware of that, and they never had any intentions on staying on Ethereum. It was just the first platform for which you could build. So projects like I'm working on Archain, I'm porting the DAI stablecoin onto Archain. And eventually we would like to have the same business logic on both chains that wrap up to a one token that's fungible between them. So there's no reason why you couldn't take the business logic of Maker and port that onto other chains as well if there was some sort of fundamental flaw. And then the last one is fairly straightforward. That's just what would happen in sort of in the pattern that requires growth. Any pattern that requires growth in order for the system to remain stable, as soon as growth falls enough for a long enough period of time, the system collapses. It's just how that would work. In fact, I would say that last one, so the seigniorage share idea, is inevitably would collapse. I wouldn't even consider that a black swan. That would be an obvious one. The issue would be, would it collapse within a reasonable time period? And that I don't know. So those are the kind of risks I would see for all three types.
So you mentioned third generation blockchain technology. Let's talk about that a bit, because I think Ethereum has been around for a couple of years and it's becoming pretty obvious that it has very serious limitations.
Yes. So third generation blockchain technologies, there's a few companies out there. So the one that's sort of winning, at least in the sense of price right now, is something like EOS. Cardano is also very interesting. Some things like IOTA are interesting. And then you have things like the project I'm working on called Archain. And so the basic idea here from generation 3 is to build a chain that can scale for the entire planet. And we're talking about billions of people, right? And potentially looking at a full global scale, if you had this sort of data structure that's going to be really running everything, you're talking about billions and billions of transactions a second, right? Not just like a lot, meaning Visa scale or whatever, but billions. And right now, that's just not even possible. That's not even feasible. We don't really have a roadmap for something like that. So projects like Ethereum, they have a track record of like actually working, which is very important, right? And there is a roadmap for scaling, and there's a lot of smart people working on this. But the fundamental problem with that is that the virtual machine that was chosen for Ethereum is a sequential machine. Transactions have to come in order. And that is not going to change. And the reason it's not going to change, because if it did change, all of the smart contracts that have been built wouldn't work anymore. So there's this code debt, is what we would call it. If you don't want to break things, it limits your options quite severely. So what's happening right now is the Ethereum team is trying to figure out how to get as much scale out of the system they have as possible. But they are going to end up with a system that's sort of shaped like this, where at the bottom of that is the least efficient part of the whole thing. So yeah, you can potentially do things that are not on the chain itself. You can do things like splitting up the sharding, is what it's called, splitting up like the address space and only having certain validators or people checking on certain transactions that begin with, certain digits of whatever. But that all has got to wrap up to something. And that wrapping process is going to take time. And there's just no way around that, right? So you're going to get trade-offs like, okay, yeah, you can do off-chain transactions, but you might have to be required to put down deposits in order to create these channels. Bitcoin is experimenting with these same things. They call it Lightning Network. And it's great once you have a channel open, but the process of getting a channel open is still an on-chain transaction, which got relatively high fees sometimes, and it's still not a great user experience. But once you're there, it's great. And that is true. It's just, for me, it doesn't look like it's going to work. It's just not going to work because the computational model isn't scalable. So I don't want to run the world on a pocket calculator. Yeah, you could try to strap stuff into it to make it do other things, like push computation around, but why don't we just build something better and then learn from what we've done, okay? So I'll just talk about the computational model and the things that I think are the most likely to really transform society, and just happens to be the project I'm working on, of course, right? So in our chain, Greg Meredith, who's the founder, he's a mathematician. He's a computer scientist, and he discovered a process calculus called the Rowe calculus. And if anybody's familiar with process calculi, pi calculus was the sort of the predecessor, and then the Rowe calculus has a bit more features that are much better for creating virtual machines. So some of the features that you get are things like concurrency. So in concurrency, for example, a really great example of concurrency, or a real world example of that, is when you guys bought your coffee this morning, there's very little chance that that transaction had anything to do with the transaction of me creating my own coffee in my house 1,000, 2,000 miles away, right? That's just sort of an intuitional thing. There actually might have been some weird connection, but more likely than not, there really was no connection. So in that sense, it doesn't matter whether my coffee was produced before yours or vice versa. So if we don't care in which order those things come in, that's what we would call concurrent, as opposed to like a serialized transaction. And that becomes really important when you're having a virtual machine, because if it can do concurrent processes, that is much more robust in a network sense, when you don't necessarily know when the messages are going to arrive. And when they do arrive, you don't necessarily care what order they're in, because in a block right now, in almost all blockchains, they're in a very specific order. That's what the miner does. They serialize everything. This came before that. If you don't care, then it doesn't matter, right? So that's one interesting property of Rowe calculus as a process calculus. And all of that means is it's just a way of computing. That's what the calculus does. Specifically, it's a way of building like a virtual machine. You can actually implement Rowe calculus in hardware. And in fact, we're actually doing some of this right now, which is really fascinating. We're actually going to be able to build application-specific hardware to run smart contracts, not just like mine things faster, but actual hardware that's going to speed up computation, which is really exciting. But more toward the point, so we have this core calculus, which is a mathematical description of computation, which builds the virtual machine. They're derived from the other. And then on the other side, you have the programming language, which is called Golang, which is like the language. So now they're both connected to the same thing, so they are correct by construction. That's what the word correct by construction means, that they have a same mathematical derivative that they're from. Whereas in Solidity, in like smart, you don't have that. You have a programming language that tries to create bytecode that the virtual machine can understand in Ethereum. So there's somewhat of a proof obligation in the sense of, hey, is Solidity really compiling what you think it is? And most of the time it looks like it, but you also get a lot more bytecode. Like if you have a small chunk of code, you get a lot of bytecode back out. And in fact, if you really want to be super efficient, you have to write your smart contracts in bytecode, which is a pain, but it also works really well because then you can also reason about it much better, right? But we don't have those problems, or we say we don't have the same proof obligations in our chain because they're derived from the same process calculus.
Can I ask a quick dumb question?
Yeah, sure.
What's bytecode? Is that like the code that validates that the other code did what it was supposed to do?
Bytecode is, so you know like an address in Ethereum, 0xAB120, that stuff? Those are bytes. It's encoded in hexadecimal characters, but it's just ones and zeros. So bytecode is just taking ones and zeros and then translating them into bytes, which is just like hexadecimal characters. But then each pair of characters is a set of instructions to the virtual machine. So when you send over 60, that's the code for push. And then another code for like move, you know what, the different instructions, that's what it is. So you guys know Alan Turing, right? We're all very, very, very thankful for that man and what he ended up doing. In his machine, his Turing machine that he used was like an infinite tape. And it had data on the tape. And then that data would then, based on what the reader could see on the tape, it could then either move to another part of the tape, record, which is like read or write, right? Those are the fundamental things of computation. And if you can do those things, then you're Turing complete, right? So you've probably heard that word quite a lot. That's what that means. If you follow all of the properties of a Turing machine, then you're Turing complete, which is just essentially, can you read information from some medium? Can you write to it? And can you skip to some other parts? Can some set of instructions tell you to go someplace else and do something, right? And then Turing completeness also means if I have a jump from here to here, and then this jump says jump back, it's an infinite loop. But Turing machines, a nice handy little property is that they can simulate Turing machines in and of themselves. So you can build a Turing machine inside on the infinite tape. So you get this crazy, like, and then they can go all the way down as long as there's resources, right? Which is crazy and super useful because that's essentially what a blockchain is. Your hardware, this laptop that I'm using, is a Turing machine, and therefore it can create and simulate other machines that do the same thing. But of course, we all know that if you have a blockchain that allows infinite loops, you need some mechanism to prevent that. Otherwise, the entire network literally stops.
What do you think that mechanism is?
Is that what the gas limit is for?
That's right. So we have the same thing. This is called the halting problem. We still have to have some way of terminating a loop. So we have the same thing. We have gas. And then if you run out of gas, your program stops. So it's the same idea. So a few other interesting things about our chain. We're learning from what other people have done before us. So Filecoin, Siacoin, some of these other things that are incentivizing storage, those are really useful, or Swarm, even those kinds of things. So we're implementing that into a thing that we're calling R space. So it's massive storage incentivized by the base level token, which is Rev. So you can incentivize storage with Rev. So now your smart contracts can have as much storage as you want. And the original design specification for our chain was to be able to run a social network, which is all of the video, all of the likes up and down likes, all of the images, all on chain. So that's one criteria. We can also do things like incentivizing or doing proofs of bandwidth, something like this, right? So if you've got a large data center with high powered machines, and we can tell how much you're able to put through the system at any given time and reward that. Again, we're also using proof of stake to do our validation, which is a much more economical for the planet, or much more ecological for the planet. And it's faster as well than a proof of work system. So we're implementing the Casper algorithms developed by Vlad Zamfir and Greg Meredith, who both of which are on the board for our chain. And the difference between Ethereum, who's planning to do proof of stake, and the way our chain is going to do it. So in Ethereum, the validation is going to happen on the block level. So the validators will validate blocks. In our chain, they validate logical propositions. A great example of that is just, does A come before B? That's just yes or no. And if it doesn't, then because we still do need to know when transactions are need to be ordered, because if my coffee that I made here in Seattle has anything to do with what you guys are doing, we need to know about it. And then the obvious question from there is, well, how do you know about it? How do you reason about whether or not two transactions interact? So we do this with something we call namespaces or just names in general. And names aren't anything new. We're just abstracting them much more than any previous system. So you're already very familiar with names in Ethereum and all the other blockchains. They're just called addresses, right? So these are their names. They're the pointers towards specific computational resources in a virtual machine or an address space, right? But in Rolang, we don't have restrictions on the namespace, meaning the namespace of Ethereum, the set of all valid addresses, is a subset of the R-chain namespaces possible. That also means Bitcoin is a subset. Any other structured name is a subset of the greater whole, meaning any possible name. All possible names can be created within R-chain. So this is fairly interesting because you have a couple interesting properties where if you have a namespace, a very defined set of things, then you can have specific rules for that namespace. So specific validation. So you could have your own validators doing very specific kinds of validation, either high throughput or highly economically secured, things like Bitcoin that are hard to change. You can also have interoperability because if you have the names of Ethereum sitting next to the names of Bitcoin, and you can do some smart contract stuff here and then push that code over, you can do some atomic swaps, right? And the virtual machine has been organized in such a way that it is also compatible with existing network technologies, which is just HTTP. So we can, in our chain, talk to and listen from other blockchains. Whereas right now you need things like oracles, which is people pushing data into these other smart contracting platforms for them to do anything with them. Now, there's a big caveat here. If you open a port to some service and that service pushes something back to you that's completely wrong, well, that's not great. So be careful about what you're listening to or that sort of thing. So it comes with trade-offs for sure, but we'll be able to do interoperability. We'll be able to do consensus quicker with the stake. We'll be able to have scaled global level storage. We'll have a concurrency, which will make things so much faster. We'll have guarantees about code that we don't have now with strong type systems and correct by construction. So all of these things kind of bubble up together to be something that looks to be orders of magnitude better than anything else we've had or have at the moment. So that's super exciting for me. And I think it's great to see it coming together. In fact, we've actually seen on our community hangouts a live working implementation of Casper. That's amazing, right? All of this stuff is kind of working, which is fantastic. And then the kind of the kicker is all of this fantastic technology is built around a different kind of governance model. So the model here is something that we're fairly used to in the world, which is a cooperative model. Co-ops are very well known around the world. Food co-ops are there's probably one within driving distance of both of us, right? So in the co-op, there's one member, one vote. It's not how much stake do you have or how many tokens do you have. It's one member, one vote. And there's also still a structure of which the people can get stuff done. Anytime we see organizations or groups of people specializing in any one thing, they tend to get separated and pushed off into their own organization. So now we have like our co-op in the United States. We're looking into the process of what it would look like to start a co-op in Berlin. We have venture capital firms that are split off that are used to create investments in new startups that are going to build on the platform. We're trying to get started a marketing organization to do sales and marketing for multiple organizations at once. Research and development, which is super important in something like this. So we did a huge tour of some of the top tier universities in Europe not too long ago. And out of that, we were able to spin up a research group that's independent and continually pushing in new innovation pipelines for the roadmap. As new things become specific, they become wholly separate and kind of autonomous. And I kind of think the idea of many organizations tightly coupled through economic incentives through an underlying token that are pointed in the same direction, that are managed on their own, but still sort of have the same culture, or different cultures, but have the same vision for the future, seems to be working out fairly well as an organizational structure as well. So that's kind of our chain and kind of blockchain generation 3 as I see it in general.
Is this kind of a general purpose platform, or do you see it having very specific applications?
Yeah, very much general purpose. It will be the de facto platform for smart contracts for anything that requires scale of any kind.
So where are you guys at right now with the project? What stage are you at?
Well, the project has actually been around for quite some time, but it was under a different project previously. So there was a bit of a messy split with another project called Scenario about a year and a half ago. But there was a lot of development that happened up until then. And Greg has actually been working on stuff like this for 25 years. So he did a version of something close to this for Microsoft called BizTalk, which is sort of, it never really, well, it does work very well in commercial settings, but it's a very kind of centralized sort of system. It's not really meant for blockchains. But the Rowe calculus has been around for, 15 or 20 years or something like that. So the math is very well known. We've actually had a lot of time to kind of work on this. Like I mentioned, we have a working version or implementation of Casper. Right now on our GitHub page, you can download the node, which just is called our node. And you can spin it up and it'll connect, bootstrap to the existing network and talk to other peers. I think at this point too, it's actually sending blocks around, which is just random bits of data that it's going to validate on. It's not doing anything interesting. Rolang is completely done. The semantics are there. It still has a ways to go to make it a little bit cleaner and more understandable because it is a very kind of different language than most people are used to. So right now, I don't want to give too many forward-looking projections, but it's not unreasonable that we'll have a testnet within several months. And then after the testing phase, let's say perhaps 6 months to 8 months after that, the what we're calling Mercury launch is very likely to occur. And then the next version after that will be Venus, then Terran, Mars, and we'll see how far we go from there. But right now we're working on the specifications for Venus and Terran as well. So fairly soon. Fingers crossed, and it's always 2 weeks out, it seems like, with software development. But you can actually spin something up now on your computer and see what it does, which is fairly good sign, I think.
Cool. All right, that's it for this episode. Thanks for listening. For all the show notes and links, go to cryptoradio.io/Kenny1. You can find the second half of this episode at cryptoradio.io/Kenny2 once it goes live. To check out MakerDAO and the DAI stablecoin, go to cryptoradio.io/Maker.
If you're new to the show and you'd like a list of our top episodes and resources, go to cryptoradio.io/start. If you like our podcast, you can subscribe, share, and follow us on social media and leave us a rating and review on iTunes and elsewhere. It helps others find the show, and we really appreciate it. You can find all those links at cryptoradio.io/start. And finally, if you want to be a sponsor of our show, go to cryptoradio.io/sponsor. Thanks for listening, and we'll see you in the next episode.